Thank you very much, Claire. Good morning to everyone. It's a pleasure to have you here and to be back to Sintra. And we are going to start with the labor market. The labor market perhaps has not attracted a lot of attention lately, perhaps because the performance of the labor market has been quite positive. If you look at the unemployment rate in the euro area, an all-time low since the incorporation of the euro, record levels of employment, but all of us, we believe that this is a key element in order to improve the performance of the general economy. In order to analyze all these aspects, we have Benjamin Schoefer, professor from the University of California at Berkeley, and you have made a rich contribution, I have to say, to the analysis of the labor market. And it covers, among other topics, the labor dynamics in both the euro area and the US, the role of labor hoarding and the retention schemes, the importance of labor market institutions and the regulation of the labor market, and demographics and immigration. But before going to give you the floor, Benjamin, some simple housekeeping rules. Benjamin, you will have 20 minutes to present your paper. And afterwards, our second speaker, that is going to be Nicola Fuchs-Schündeln, president of the WZB Berlin and professor of the Goethe University. And you will have 10 minutes to make your remarks. And afterwards, Benjamin, you will be able to react to the comments made by Nicola, and afterwards, we will open the floor for everybody. So without further ado, Benjamin, you have the floor, 20 minutes.
Thank you. Right. Thank you very much for the kind introduction. Thanks for having me. And I really look forward to reflecting here on links between European labor market institutions and European competitiveness. And I'm an economist that focuses on macroeconomics and labor economics. And what I try to introduce and revive is exactly that link through the novel channel of what I'll call labor market dynamism or business dynamism that generates a new link between labor market institutions and European competitiveness, macroeconomic performance. So let me jump right in. And in the spirit of the Draghi report, or unfortunately, the next slide is not coming up. I'm very sorry. Wonderful. Thank you. It's going to be a comparison that I'll cast as a transatlantic gap in macroeconomic performance, GDP per capita, where I'll put the United States in the spirit of the Draghi report, and last year here in the forum, Antoine Bergot at 100, and then plot European macroeconomic time series as a fraction of the US outcome. Now, GDP per capita, post-war, post-World War II, we've seen catch-up growth through the 1980s. That's when the debate of Eurosclerosis, which is in the title of the paper, has started. We settled in at about a 20% gap since the 1980s, and then somewhat worryingly, this gap has widened to about 30% recently and seems to be on a downward trend. Of course, GDP per capita is a story of, or can be decomposed into two margins. One is labor productivity, GDP per hour worked in Europe, that has actually grown a bit longer than GDP per capita through the mid-90s, but then also slowed down to about a 20% gap, and the rest of it is accounted for by the fact that we as Europeans work a bit less than in the US. Now, of course, this has sparked concern and policy concern specifically. This is from the Draghi report last fall. Let me just highlight some buzzwords over here that have been linked with the underlying dynamics of TFP growth and capital deepening that we're missing in the United States. There's an innovation gap, particularly in advanced technologies, stuck in static industrial structures. We don't have new companies entering. There's a lack of dynamism, particularly in the tech sector and in emerging technologies. That's an extensive challenge. And other observers agree. For example, growth has been mediocre, deteriorating compared to the United States. We kind of focus too much on existing technologies, large firms rather than new firms, external finance is missing, equity finance, higher investment in R&D, and then growth will come in those sectors such as tech. And we also miss production innovations. We're falling behind the US, in R&D spending, new products, and we lack the dynamism. Now, these two quotes are not from fall 2024. The first one is 20 years ago. It's the Sapir report on European competitiveness. The second quote actually is 40 years ago. It's Herbert Giersch's infamous Eurosclerosis piece, October 85, and the Financial Times article in January 1905. So these debates are old. The symptoms are also relatively old. This is a laundry list that you see in the paper. They show up in various forms across policy reports and academic papers. And of course, the initial symptom of the transatlantic gap was glaringly related to labor market institutions because there's high European unemployment that focused our attention to institutions such as collective bargaining and unemployment insurance. Now, just in a simple time series, this is high European unemployment that was high in the 80s following the shocks of the 70s, stayed high, stubbornly high throughout the 90s, and then fortunately started to come down towards the end of Eurosclerosis in the late 2000s. And then, of course, the global financial crisis hit, pushed up unemployment again, and now we are, as Luis de Guindos mentioned, we are on a good trend towards record low, at least compared to post-80s unemployment level in the European Union. But it's still high compared to the US economy, of course, which is the black line over here, where unemployment rises and then quickly falls. But indeed, we are on a good trend in terms of the unemployment measure. Now, the end of Eurosclerosis here, famously, we thought we are at the end of Eurosclerosis, at least when it comes to the measure of the unemployment rate. In the bottom right corner, you see a 2009 article by Tito Berri and Garibaldi that says we are beyond Eurosclerosis. We figured out how to improve macroeconomic performance, at least when it comes to the unemployment transatlantic gap, US versus Europe, and indeed long-term unemployment has come down. Now, what about the other outcomes that we now link with this transatlantic gap in macroeconomic performance, innovation, TFP growth, capital investment, startups, tech, and GDP per capita optimally? Kind of these time series that I started the paper with. Now, where should we find the sources of that gap? And here I plot highly imperfect indices and time series thereof of three markets: financial markets, product markets, US versus Europe, and then the labor market, as you might guess. And in terms of financial markets, arguably, while more work remains to be done to, for example, have reduced capital market fragmentation and have deeper venture capital and equity markets in Europe versus the US. Europe is the blue line, the US is the orange line. We've converged on that dimension much more so. Same thing on the product market than in the labor market, where arguably Europe and the United States, if anything, have increased the gap in terms of institutional rigidities or features. Of course, institutions have a purpose. We've deliberately set up the European model with strong labor market institutions, labor taxes, employment protection regulations, co-determination, where workers share formal voice in corporate decision-making, or collective bargaining. Now, these are the four example facets of European labor market institutions, where you see in many of those, Europe has actually become more rather than less different from the United States. Now, this is, in a sense, a paper in a nutshell. We know a lot about how labor market institutions, such as the ones that I just described, affect macroeconomic performance through a relatively narrow link. All of these features, we know how they affect the unemployment rate and perhaps wage levels or wage rigidities. But we don't have a lot of evidence on how these labor market institutions shape all the other new facets of Eurosclerosis, arguably, and that's what I focus most of the paper on. So kind of, this is the standard link, the old view. We know a lot about unemployment, employment, wage levels, but that new view that are highlighted in the paper works through what I call dynamism, and what the frontier literature in macroeconomics and labor economics would call, for example, labor market dynamism. How much are we willing to reallocate between growing and shrinking firms or sectors, or reskill, or equivalently, on the other side, business dynamisms. How can employers and firms restructure and adapt to changes in light of European labor market rigidities? In a sense, this is what I highlight in the rest of the paper as a link on which we know much less, but that I try to convince you, and in the paper there's much more evidence on this that might account for a lot of the transatlantic gap. So let me briefly dwell, but then move quickly to that new view, because I guess it's the new view, on the old view, and focus on unemployment. You've seen that time series before. Arguably, of course, Europeans' unemployment level is at a record low. A lot of heterogeneity remains and perhaps work to be done. We know that, but we're on a good trend over here. And in the paper, there's much more that I do using new microevidence on regional heterogeneity. For example, the age dimension, how well have we done in terms of youth unemployment, which, let me just show you here. In most countries, the US is the gray bar. Youth unemployment, for example, stays high. And we still know that labor market institutions play a role in those labor market disequilibria, in a sense. And in the paper, there's much more, but as I promised, I'll move to dynamism. Now, you might recall the dynamism debate from the perspective of unemployment versus employment. That's what we've traditionally focused on, how to bring down unemployment. And a canonical measure of dynamism in that old perspective is to ask, for how long have you been unemployed? So here we ask the unemployed individuals. Here in the US, that's what I start with. For how long have you been unemployed? In the United States, only about a fifth, say 20%, that it's been more than 6 months. Now, that's a long-term unemployment measure that the BLS, the Bureau of Labor Statistics, collects. They don't even collect longer measures than that, and the green bar is short-term unemployment, less than 6 months. And only Denmark and perhaps Norway come close in Europe, and a lot of the other countries have much longer unemployment spells. And that's a traditional measure of labor market dynamism. And in Europe, of course, we measure much longer spells. The purple line here is unemployed for more than 2 years, so arguably there's a lot of unemployment, long-term unemployment left even in Europe. The green line on the right panel here is the long-term unemployment rate, more than 6 months. One way to assess that transatlantic gap is to also plot overall unemployment in the United States. That's actually higher than long-term unemployment itself in Europe. So there are more unemployed, long-term unemployed individuals in Europe, in aggregate at least, than there are total unemployed in the United States. But that's the traditional measure of labor market dynamism. I want to move to kind of the labor market dynamism and business dynamism that has more plausible links with a macroeconomic performance indicator that are at the top of our mind, at least since the fall of 2004 and arguably since 1985. Now, to measure this in traditional views, to just ask how quickly do you get reallocated to employment. On the x-axis here, I plot the unemployment to employment transition probability at a given month. In the United States, within a month, 25% of people found another job if they are unemployed. And on the y-axis, you see the probability that you lose that job again. So the US labor market is very fluid. You move in and out of unemployment very quickly. And we all know that the European labor market, this is updated in a sense on Blanchard 2006. Here, we're still in this relatively non-fluid, sclerotic, if you might say, labor market where unemployment spells are much longer. We just saw this. But they also get to keep your job for a long time. Now, you can also take a look at another y-axis, which is a new view. You keep your job for a long time, but you don't have to wait until you become unemployed. The European labor market, and compared to the United States, is actually also sclerotic or non-fluid from the perspective of employment to employment transitions. Once you have a job, you kind of stay put there, rather than moving to the next opportunity into the growing industry. And on the y-axis here, I plot the probability that you switch employers. And Europe, just as it's non-fluid in terms of the other dimensions, it's also relatively sclerotic on that margin. Now, let's switch gears to the 95% of workers that already have a job and ask how they interact with labor market institutions, rather than the 5 or 10% of individuals that are unemployed. How many of us have been on the same job for at most a year? In the United States, that's about a quarter. In European economies, depending on where you look at, it's less than 10%, less than 5%, less than 3% in some of these cases. So new jobs and dynamism you already see in the simple time series. And the flip side of that is a lot of us in Europe have lifetime jobs. The black line is jobs that have lasted 20 years or longer, which in the United States is about 10% or less. In many European countries, it's 20% or more than 30% of people haven't switched jobs, have been in the same job for more than 20 years. Now, why does that matter? Well, it's going to generate growth, as I argue in the last part of the paper. But before moving there, I want to quickly point to the kind of symptoms of job mobility and fluidity that Europe does have. Here, I'm going to add fixed-term jobs. And I'll call that bad dynamism in Europe, where kind of you're forced to leave your employer because the contract ends. And that's an evasion response to strong labor market institutions, of course. Now, those have been on the rise. That's the black line over here. 14% in Europeans' workforce are on a fixed-term job, 12 to 14%. And a lot of heterogeneity across countries, of course, and that has accompanied the decline in unemployment. So in a sense, perhaps we don't know the answer to that definitively. The rise of dual labor markets have facilitated perhaps also, or at least accompanied the decline in unemployment. You see this through a lot of other margins, part-time jobs which are just skipped over. You see evasion of collective bargaining and so forth. But I want to move to the good type of dynamism that arguably is linked with the macroeconomic performance indicator with which we motivated the talk, I guess. And I'll start with labor market dynamism. And I'll first ask, why should we care about labor market dynamism? Much more on the paper. But one perspective is, let's plot on the x-axis the probability that I switch jobs here at the A level. In the United States, that's about 10% of people switch from year to year their job directly without ever becoming unemployed. Wage growth over the career of American workers is large. On the y-axis, it's 0.75. You grow your wage growth over your career life cycle by 75%. the more we switch jobs. As we go to the left, we see Europe come in again, and we see that facets of lack of labor market dynamism show up as a decline in wage growth. Now, wages reflect productivity of a worker, and hence that's already one obvious link that literature has established between labor market dynamism and productivity at the individual level. You see the same pattern at the macroeconomic level, and now rank countries on the x-axis by the same measure, and now put economic growth on the y-axis. And you see the same slope. This is the average annual growth over the last 10 years, 2010 to 2019, before COVID. It's a symptom of a growing economy to have dynamic labor markets in which employees switch between different companies, move up the job ladder, for example. In the paper, I discuss the plausible causal links between these and discuss, of course, also identification problems, which is kind of things go both ways, they're omitted variables. And the literature has linked these dynamics with, for example, population aging. We know that younger people drive labor market fluidity, and across US states, you see that states that have become less young have become a bit older. You see dynamism shrink and growth also shrink. Of course, many things happen when societies become older, but that also speaks to probably challenges that we'll face and maybe discuss today, which is aging in the population. Now, which institutions affect labor market dynamism? And I think it's difficult to not rethink many of these institutions through the lens of labor market dynamism that we usually linked with the effect of unemployment insurance, active labor market policies. Employment protection specifically might affect labor market dynamisms through ways that we don't understand well, but if you ask a European worker, why don't you switch to a better paying employee? Here's what they tell you. That's indeed what we did to German workers, iron quarters. Why don't you switch to a higher paying job in Europe? And the main answer German workers give you is, my current job, the top bar over here, about 40% of workers, 45% of workers tell you my job is secure here. The next job will pull me down in terms of seniority and hence employment protection. The next job is less secure than the current job. Now, therefore, we see lock-in effects of these European labor market institutions that stifle labor market dynamism, the good kind of labor market dynamism that we know is linked with microeconomic growth at the individual worker career level, and plausibly also all the benefits that we want from a dynamic economy. This is a laundry list of my attempt to rethink these old labor market institutions that receive very little attention these days compared to the height of high European unemployment. Employment protection, typically increase in seniority. Probationary periods mean that in the next job you can get immediately fired without cause. Last in, first out rules formalize your protection in the firm by your tenure rank, by your seniority within the company. If you switch jobs, you're at the bottom of the ranking again. Severance pay, for example, often mandatory severance pay that exists, for example, in Austria, used to be linked to tenure. And you lose that opportunity to have high severance pay once you switch employers. Austria has reformed its labor markets to permit you to carry that seniority severance pay as an account with you, make it portable. Wage dispersion is compressed in Europe. What are the benefits of switching? I have some research on German job searchers, employed job searchers, that indicates that often German job searchers, at least, perhaps in the US, there's some follow-up work, they don't know the benefits of job searching. And if you tell them that there are wage growth expectations you should have if you switch employers, they seem to be more willing to switch jobs. Now, non-compete clauses, of course, are part of that suite of labor market institutions that prevent job switching. More research is needed there. But for sure, short-term work and labor hoarding policies are institutions that lock you into your current job because you get your large fraction of your previous salary without having to come in at the same amount of hours, of course. Now, but the missing debate is, here we highlight institutions that stifle labor market dynamism. You might also want to ask, what are the institutions that promote proactively labor market dynamism? And that debate we for sure don't have. Kind of call this in the paper active labor market policies for the employed rather than the unemployed. How can we generate dynamism on that end? So that's my attempt to talk a bit about labor market dynamism. The second facet of dynamism that I think we usually don't associate with the labor market institutions is on the employer side. And that might seem to be far removed from labor market institutions. Business dynamism, restructuring, operational flexibility. But I think if you start looking again through that list, and if you talk to employers, and I'll cite some evidence, a lot of that dynamism on the business side, especially the kind of dynamism that, say, in the Draghi report and 20 and 40 years before, what is the problem? You can point back to labor market institutions. So one facet of this is dismissals. That's the most extreme version of business dynamism. If you restructure, dismiss some workers. Think the metaverse in Facebook. In the United States, about 1% of workers become unemployed through a layoff or dismissal in a given year. In Europe, essentially, that quickly goes towards zero. So dismissals are incredibly rare in Europe. You cut employment by not hiring, or you offer some other benefits and kind of keep these workers around. In fact, often you have to reassign them within the company rather than dismissing them. Now, what are margins where the labor market institutions obviously constrain operational flexibility? It's dismissals. For sure, that's the direct effect of employment protection. That's their purpose. But actually, European labor market institutions even influence how to hire, say, works councils in Germany, or whom to hire and how quickly to hire. Adapting job titles of incumbent workers that continue to be in your company is difficult due to employment protection and co-determination rules, for example. Now, these constraints arguably bind particularly for industries that depend on dynamism, industries and activities. Now, let me walk you through some existing examples, and much more research is needed here. That's particularly timely. What about ICT, information and communication technologies? In the first wave of digitalization in the early 2000s, let me show you two bars here. For industries that were heavy in ICT, you saw a large increase in worker relocation, dismissals and hiring, shifts between industries and employers. Now, don't worry about the y-axis, because I'm going to show you the same increase in relocation that happened in low ICT industries in the United States. So clearly, if you can't relocate, that's going to be very difficult. Now, do we see, therefore, ICT and digitalization be less pronounced in countries that have more rigid institutions, such as employment protection? X-axis is an index of employment protection. The US is at the very left. You see the most, for example, here, servers per head in the early 2000s over here. And you see this almost too good to believe ranking of countries by employment protection for all measures of ICT. Here for ICT spending as a share of investment, and for all of these measures that are plotted. Now, this is about capital markets and venture capital and equity markets. Was it about employment protection? You can also plot venture capital as a share of GDP, and you get a very similar relationship. So that suggests actually that this dynamism view of labor markets on the business dynamism side and labor market dynamism sides would shed new source on that transatlantic gap, particularly in the regions and the areas that we've highlighted at the beginning of the talk. Now, there's a fatalistic view. Are these fixed institutions? And is it a comparative advantage that's ingrained in the European model? That would mean inevitably we lag behind in these highly dynamic industries and activities and occupations. Or could we reform the European model in a way that makes it easier for these dynamism-dependent activities to succeed? Now, we already have, within the European model, some carve-outs for labor market institutions and regulations. For example, small firms aren't bound by employment protection as much as large firms. Some employees, probationary period, fixed-term jobs, or high-level managers are not bound by employment protection rules. Maybe we can rethink such carve-outs also for the industries that are so urgently on our mind. And of course, more research is needed, and institutions always entail a trade-off. They are there for a reason. But this is my attempt to conclude on time. There's a graphical version, which is the graph that I started with. Rich links between labor market institutions, with all of the indicators of macroeconomic performance through mechanisms that we can dub dynamism. And this is the lengthy conclusion. Thank you very much for your attention, and thanks, Nicola, for the second talk.
Thank you very much, Benjamin. Nicola, it's your turn.
Thanks.
And you have adjusted perfectly.
Waiting for my slides. So thanks a lot for giving me this opportunity to discuss this really broad and thought-provoking paper. So I will try to give a very quick summary and provide you some additional evidence to what I see being the main point of the paper, namely that labor markets matter for growth in Europe and beyond, of course. So these, on the left, you see the same graph that Benjamin showed before, just expressed differently. So since the early 2000s, we have been experiencing relatively sluggish productivity growth in Europe. So in red, you see the US, and in blue, the euro area. And at the same time, what you see on the right is that we had low investment in new technologies in Europe than in the US. So again, the US is in red, and then you have France, Germany, and Italy, and this is IT-related capital stocks. So clearly, US firms invested much more in IT capital. So at the same time, the unemployment rate, thankfully, has largely been under control and is at almost record lows nowadays in Europe. So the focus of policymakers and researchers alike shifted from labor market institutions to other institutions, so for example, innovation policies and capital markets. However, Benjamin argues forcefully, and I would say convincingly, that labor market institutions still matter. So in the 1990s, many countries reformed their policies targeted towards unemployed individuals and thereby successfully brought down the unemployment rate. Policies targeted towards employed individuals were largely left untouched. But in periods of substantial structural transformation, these are policies that matter for growth. So policies like employment protection regulation or co-determination, they protect job matches. And for growth, and when you have a lot of technological change, you need some kind of experimentation within firms or across firms. And for that, especially job-to-job transitions are really crucial. So in our period that we are in, I would say job transitions, ideally direct job-to-job transitions or through short periods of unemployment, are really an engine of growth. And Benjamin showed these correlations with growth, with wage growth on the micro level and with macro growth as well. So how different are the institutions in the US and Europe? I'm sure you all know this graph here plots the unemployment rate from 2018 to 2023 in the US in red, and then in Italy, France, and Germany. And clearly, we all know that in the US, in recessions, firms let go of workers, and then later on, they rehire the workers or they hire new workers. While in Europe, we focus on policies that maintain worker-firm-specific matches, so for example, on short-term work. So which policy is more conducive to growth? It really depends on the times you are in. There's a very nice paper by Hirschbein and Kahn that show that firms in regions that were more affected by the Great Recessions, they used the recessionary layoffs to increase permanently the skill level of their workforce. They subsequently invested more, and they subsequently had higher wage growth. In Europe, by contrast, we focus on maintaining firm-specific human capital, and this is very beneficial in stable times if we just have temporary shocks. But it's not conducive to technological change. And in ongoing work with Chiara Lacava, we analyzed the firing ban that was imposed in Italy from March 2020 to October 2021. And we find similarly to the US experience that firms that were less affected by the firing ban, they had more separations, but they also had more hires, and they used these hires to increase the skill level of their workforce. So before I showed you, and I didn't mention that, that the difference in labor productivity between the US and the Euro area grows specifically in recessions, and I mark here the Great Recession and the COVID period. So it seems like the US policies make it easier to use the recession also as a period of restructuring and then to spark future growth. So let me take a step back and discuss the two main challenges that I think we nowadays face in European labor market. The one is the one that Benjamin mentions, namely labor market dynamism. And he showed you indices of employment protection. I want to give you some different evidence on that comes from the International Social Survey Program. So here you see that Americans perceive it as easier to find new good jobs. They are less worried about losing their job. And they have also a higher probability to engage in job-to-job search. So this is all in line with more flexible labor market institutions, as Benjamin explained. It could also indicate almost a different attitude towards labor market that you see in workers in the different areas. And here is more evidence on that. So Americans are more likely to say that upon unemployment, they would be willing to accept a job that requires new skills. And they would be willing to move within the country, which obviously in the case of the US means much larger distances than in most European countries. So what I want to caution is that from my own work also, we found that living under very different institutions also eventually affects culture. And it might be that even with reforms of labor market institutions in Europe, it would take some time to generate the same dynamism that we see in the US. And the second main challenge that we face in European labor markets, and that is less discussed in the paper, is that we will likely have increasing labor shortages due to decreases in labor supply. So the number of individuals in the working age population is predicted to decrease significantly in most European countries over the next decade. And here I show some predictions from the UN. And the predicted decrease is more than 10% in Germany and Italy. And on top of that, I've shown in previous work with Alex Bick and Adam Blandin that also Europeans have decreased the hours worked per employed person quite significantly over the last 2.5 decades, for example, in the case of Germany, by 4 hours per week. We did have increases in employment rates, but they were not large enough to overcome that change. So this comes on top of the demographic pressure that we are experiencing. So we should really think that labor supply will decrease in Europe over the coming decades. So let me link these two. So the decrease in labor supply is likely no good news for labor market dynamism because it increases the bargaining power of workers and unions who are in favor of more labor regulation, and rightly so, this is their job. At the same time, we are in the midst of a period of substantial structural change. So what is the way forward? And I think Benjamin only alludes to that, but here I would really think we need more creative thinking. So something that we might want to think about more is to have a dual system of labor market regulation, where we want to keep the job protection, especially for low-income earners, that we really value in Europe, the protection that we provide to low-income earners, but at the same time, create more dynamism for high-income earners who are the ones who can live with income risks more easily and who have the skill sets that we use to make that we need to make good use of the new technologies. So last, let me give you some quick evidence on where we stand in terms of labor market fluidity and technology adoption nowadays, looking at the case of the adoption of generative AI, which is likely the technology of our days. So to get some evidence on this, we just fielded an internationally comparable and representative survey in the United States and 6 European countries. So that survey was in the field at the end of May and beginning of June, so I show you here some very first evidence on that. What we find in this survey is that the share of workers that use AI is at around 36% in the US, and it's lower in all European countries. In Germany, for example, it's 26%. In France and Italy, it's lower than that. Not only are European workers less likely to use AI at work, they also use it less intensively if they use it. So here on the x-axis, you see the same data that I showed you before, the share of workers who use generative AI. And on the y-axis, you have the share of the users who use this more than 1 hour per day. And you see how Europe lags behind in both dimensions. So this is just rare usage. I think the real issue is like how good use do you make of that, and that is what we still have to learn. But it gives some indication that the US is faster in adopting this new technology. And here I created this graph that replicates basically the graphs that Benjamin showed for computer adoption in the 1990s. So here on the x-axis, you have the Employment Protection Index from the OECD. And at the y-axis, you have US AI usage at work, and you see this same negative correlation that you saw before. So I really want to caution, these are just 7 data points, just 7 countries, and there are probably a lot of unobserved third variables that also correlate with that. But somehow it gives this picture that we have a similar situation as we had it with computer adoption, and I think we could learn about what we learned from back then. How can we make better use of these technologies? So let me conclude. I think Benjamin starts out his paper with really saying we have sluggish productivity growth and also low rate of investment in new technologies in the euro area. So what are the reasons for that? And he falsely argues that we shouldn't only look at innovation policies and so on, but that labor market dynamism matters. So it's really also the creative destruction of job matches, especially at the high level, that we need to make good use of new technologies, and employment protection prevents risky and disruptive innovations. So what are the implications of the paper? I think they are threefold. So for policymakers in general, I think the implications are not to lose sight of labor market reforms and to focus especially on encouraging job-to-job transitions and also continuous learning, which we will need if we have a lot of new technologies. For central bankers, so the majority of the audience here, I think the paper really cautions that there's no easy way out of low potential growth in Europe, and that we could expect a rising bargaining power of workers, which could also lead to inflationary pressures. And for us researchers, I think the conclusion is that we really need much more causal analysis of the role of labor market institutions for growth and innovation. And also we need more creative thinking of how can we reform labor market institutions such that on the one hand we create more dynamism, but on the other hand we keep the social protection of workers that we very much value in Europe. Thanks a lot.
Thank you very much, Nicola. I don't know whether, Benjamin, do you want to react to the comments? Because I think that you have coordinated. I saw that you were talking last night.
And this morning on the way here. To the following degree, I sprinkle throughout the paper this idea that, well, more research is needed, as Nicola mentioned. And had I known of Nicola's discussion before, I would have said, well, this is the kind of research that I think we need looking at AI and also pointing out AI adoption across countries. I think this is fantastic. Thank you very much. And seems to extrapolate the time series to the present day. Topics, yeah.
Very good. I will take advantage of my position here, and I'm going to ask you a couple of questions to both of you. The first one is, well, we have a lot of, debate and proposals in Europe about the capital market union, but we do not hear much about the labor market union. Do you think that it would make sense? Or perhaps, whenever, we talk, I see Valdis Dombrovskis there. When you talk about regulation in Europe, you have to be careful, huh? Because perhaps, instead of a race to the bottom, it will depend on the benchmark. What do you think? Do you think that it would make sense?
I think if we have discussion of joint labor market institutions, then it's mostly about the European unemployment insurance, and I think this could be very valuable if we have large shocks, as we had in the Euro debt crisis and so on. I think in the spirit of what Benjamin presented, we should think also of these policies that encourage job-to-job transitions. And there, I would say, the state of the labor market institutions is quite heterogeneous across European countries. And I'm not sure I see so much benefit of unifying that, rather than maybe talking more about what are the experiences, what can we learn from each other, what works well, for example, in countries like Denmark that have more flexicurity, and in which sense can we use that in other countries? And there I think we have to be careful, because obviously it's not only the labor market, it's the entire systems that have to fit with each other. But I think a more European discussion about these issues would definitely be valuable.
Benjamin?
I'd agree with that. While catching up on high European unemployment in the 80s and the 90s, I read a couple of papers, and there seemed to be this idea that we all know what we should do about high European unemployment, but the problem is political in a sense. I think Jean-Claude Juncker said, well, we know how to solve the unemployment problem. The problem is we don't know how to get re-elected afterwards. I think here it's the case where we don't necessarily know what we can do to make European labor markets more dynamic, although there are some kind of good deals where you say, well, let's let you keep your protection, but you get to move with your job protection to the next job, and there's a way for us to make employment protection not stifle dynamism while maintaining protection for the worker. So I think these are the win-win solutions that we could explore, whether on the European level or the national level. That's an open question, but there are some countries like Denmark or Sweden that seem to have more dynamism than others. I think we can use the European laboratory to learn from each other in a sense.
Very good. And my second question is about immigration. Immigration and the influence and the impact on the labor market. Because, for instance, it's quite impressive the case of Spain. A lot of immigration flows, and the evolution of the labor market is one of the best, or perhaps is outperforming the majority of the European markets. What do you think about the impact of immigration from the perspective of the labor market, for sure?
I think we will need immigration. So I presented these figures on the decrease in labor supply, and it's going to be a real issue in many of the big European economies. And so one way to counterbalance is immigration, but at the same time, we have to become much better in integrating immigrants into the labor market. I think you are probably better there in Spain already than we are in many other European countries. It might be a language issue, but there might be also other things that we can learn then from other European countries. And obviously, we all know that it brings a lot of societal challenges to integrate immigrants more generally into the population, to integrate the children into our schools, and to make immigration something that is accepted by the broader society. And that, I think, is a common European challenge that we are facing, that we should not lose sight of. It's a very important issue.
Benjamin?
On top of this, I'm a dual US-German citizen now. So I'd like to think that immigrants, and it's true, it's borne out in literature, are more dynamic and mobile and flexible than native-born workers and employees. So I think you look into research and you find that it's the immigrants often that start businesses, that switch locations. Evidently, they've switched countries and start businesses. And so I think also from the dynamism perspective, that's probably a good bet to make. But I don't have anything else to add to Nicola's fantastic summary beyond that.
Okay, very good. So, I see there, our specialist in the Governing Council on Labor Markets, that is Mario Centeno. We can collect, 3 questions. Mario, Joaquin, and the lady behind. Mario, please.
Thank you for bringing this topic here for us. I still miss a few things in the analysis, and I would like to mention those and see. It's not to blame what you did, because information, data for European labor markets is not abundant, but still we can do a better effort, I guess. So the first thing that I miss is a reference to wages. I mean, you talk about the labor market, but there's no big picture for wages here, and I think it's important for us to bring that into the picture. And from what I see, looking at the European labor market in the last 10 years, there was an amazing change in the European labor markets. Take a few numbers. Mobility. Of the 10 million jobs that Europe was able to gain in the last 5 years, 6 million are occupied by people that work in a country different from the one they were born. This is 60% of all jobs created in Europe on net terms that are occupied by migrants. This is a huge mobility in the European labor market. The European labor market proved quite resilient to those crises. If you look at the Beveridge curve, it barely moved, contrary to the US that shifted out enormously. And that's, again, a matter for efficiency for our labor market. And then I can give you a couple of numbers for Portugal, because we have very good data for this in Portugal. In the last 5 years in Portugal, on average, to create 150,000 jobs per year, the number of hires that we needed to create those jobs were 1.5 million per year. So for each job created, there were 10 new contracts in the labor market. This is a huge mobility. This does not pay merit to the indicators of employment protection that you showed us, and they are not reflected in the reality of the labor market. So my claim, and what I would ask you, is let's go a little bit deeper on the numbers, because that will make a big difference. And in terms of wages, you are absolutely right. The wage gains over a career occur when people change jobs. But again, if you look at the numbers for Portugal, in the last 5 years also, people moving from one job to the other experience an increase in wage of 14%, and those that stayed in the same job of 7%. So this implies that the labor market is working, and it's working quite efficiently so that people can really understand that. So I think it's just that. And I used to praise the labor market functioning in Europe during this cycle. I think we were the first policymakers that did not face the sclerotic labor market of Europe. So that's my
Thank you. Thank you very much, Mario. Joaquin, please go to the point if you're so.
Yeah, I'm very brief. So excellent paper and excellent comment. While you spoke, the German labor numbers, the unemployment numbers came out for June. They're 190,000 higher compared to last year. In my interpretation, I think the simple answer is because of the sluggish economic growth. You ask for creativity. What can we do in an aging society, in Europe we are living in an aging society, so we are running out of workers. So there are different, let me say, things we can do. I will ask you a very concrete question. What do you think, which role can the minimum wage play in an environment where I think skilled workers are, let me say, they're getting less and less, but also there are so many new jobs are being created, especially in the service sector, on a very low paid level. So I think we have to take into account not only, let me say, the top salaries, also the lower salaries, and what does that mean in your understanding as economists, what we can do maybe on top of that, or is that an essential part, or is it more or less useless? Thank you so much.
Thank you very much, Joaquin. And the last question afterwards, you can reply.
Silvana Tenreiro, London School of Economics. Thank you for the paper, great discussion as well. So when it comes to productivity growth, we have some success stories in Europe, including Denmark and Portugal, whose TFP growth has been as high as the US in the last 15 years. And so my question for both the presenters is really the US labor market our aspiration or the aspiration for Europe, or is there a third way, the Danish or the Portuguese way?
So, Nicola.
Yeah, let me be short, as these are all interesting questions. And so first, I think already the first and the second question shows that we have a lot of heterogeneity in Europe, and that's also what Silvana stressed. So Portugal is for sure in a different situation than Germany is, and that I think could be an advantage. So we could learn from each other, just as you said, and that's also why the US is a benchmark in the paper, and I think it's always a useful benchmark because it's external. But that doesn't mean that we should emulate the system. We have very good reasons to support our systems of protection, but we have to think about, and I think there are ways, and Benjamin is also proposing, like taking your tenure with you, to do that in a creative way that still encourages these job-to-job transitions, because that is something that we really need, and that is very well shown, and even in the Portuguese numbers, this is what brings wage growth, and we have these information treatments also. If you let workers know, it has an effect. So I think that's something we can do much more, and we academics should think more about. So, and then also in both your questions and the first one, the question on wages is not only what is wage growth, so what is also with inequality, and that's, I think, where our labor market institutions are so valuable, because they really protect the low-income earners, and the minimum wage for sure could play a role in that, and I think the new research on the minimum wage shows that it has positive spillovers of the entire wage distribution, so it's not something to be seen as negatively. I would say overall it's positive. The right level is always the question, but I think it's good that countries like Germany took this up, and that it has a positive effect on inequality reduction.
Benjamin, anything to add?
Thank you very much. So on the comment of Silvana's and Mario's on the Portuguese case, I think these are exactly the conversations we should be having, which is how come some countries do better than others on some dimensions, what the institutions or the policies or the demographic advantages that lead those countries to do better on the margins that I try to put at the forefront. And I think we don't necessarily know. We see the symptoms, but if I were to ask Mario and Silvana kind of what's the institutional reasons that would make Germany have performed as well as Portugal perhaps in the aftermath of COVID, I think we'd love to know, and research should be done on that. Regarding whether we should become closer to the US, of course, it's an easy comparison because there the gap is large. Personally, I think the institutions are there for reasons, and Europeans choose them. Job protection, being at work in Germany or Europe and Portugal, means something very different than at the US. You have property rights over your jobs, and even in the US, philosophers such as Elizabeth Anderson say as well, kind of this, in the US you have employment at will, in Europe you have democracy at work, and maybe as citizens we prefer these institutions. There's a trade-off. When it comes to the minimum wage, exactly as Nicola said, I think it's a discussion about inequality versus economic performance perhaps, but there's evidence that a high minimum wage, at least in Germany, leads to relocation towards the productive sectors because it releases workers from unproductive jobs that perhaps the workers don't actually know that they would have gained wage gains around the corner in a larger, more productive firm.
Very good point. I move to my right. I see Richard and Ricardo, from Richard to Ricardo. Richard.
Richard and Ricardo. Richard Portes, London Business School. I see this somewhat differently, perhaps, from the UK perspective. Europe has preserved its labor market institutions, strong employment protection rules, involvement of workers in corporate decision-making, robust collective bargaining institutions, generous unemployment insurance benefits, high labor tax levels. That's what the paper pins the problem on. Well, we've got rid of all that in the UK. We have, and I think Nicola's graph showed, we have very low employment protection levels, okay? We have low unemployment, and we have very low productivity growth, right? So what's the story here? Is this labor market sclerosis really the cause of low productivity growth?
Thank you very much, Richard. Ricardo, please.
So Ben, I'd like to put 3 skeptical observations and see how you'd react to them. Number one, and these are all about the tech sector. Observation number one, the birth rate or startup rate in Europe in the tech sector is not very much lower than in the US. It's really in the growing later where the gap emerges. Number two, when we look at non-European and non-US firms, say Korean or Japanese firms that are relocating, opening branches outside of their home country, they hire workers at roughly the same rate in Europe or in the US market. Mm-hmm. And observation 3, when we look at these European firms that really grow, become unicorns, and move to the US, we don't see them shedding workers in Europe. They move to the US, hire a few workers there, but they keep all their workers in Europe. All 3 observations instead would point to more of a problem in financing, which is that it's easy to start a firm in Europe, but to grow it, you need the financing, you can't get it. Japanese and Korean firms never move to Europe for financing. They move to the US to get venture capital. And 3, the unicorns in Europe, what they do is change all of their financing to the US, not get the workers. That is, these observations say that it's really financing the story, capital market union perhaps, not so much that it's the European labor market that's repelling foreign firms, that's asking the European firms to leave and run to the US or even to start. Thank you.
Thank you very much, Ricardo. And I see Vito Constancio there. Yes. So please go to the question directly because we have 6 minutes left. And so, Vito, please.
Thank you for the paper. It's, in my view, too ambitious. Useful, then, particularly in the point where it is well illustrated that the problems of unemployment were at the start in the 80s, the issue about the rigidity of European labor markets. And that has been sorted out, as the paper shows, and that's a useful part of the paper, through fixed-term contracts, part-time jobs, and the waning of trade unions and collective bargaining. All that changed the European labor markets, and unemployment came down. And now, the idea that we still have too much rigidity, and that is the obstacle to innovation, seems a bit exaggerated to me and not proved in the paper enough. The evidence or the arguments are flimsy, and the econometrics is also, because there may be a lot of endogeneity and reversal causation. And if we look to the US, the fact that they had that jump in ICT in the 90s in particular that we missed totally, we see that the major reason was the significant venture capital that exists in the US, and it exists because they have a unified, deep and liquid capital market, and that's what is missing in Europe. Without that deep liquid market, we cannot have really a significant venture capital because they have to recoup the losses they have in many projects with the successful ones that go into an IPO in a deep market. And also, as Ricardo just reminded us, which is very significant, is the fact that the examples of innovative firms in Europe, they go to the US to get capital and to get financing. And that's another illustration that indeed that's the missing link and not so much the labor market institutions in this matter. So my question to you is precisely, one thing that you cannot address in the paper is you find some possible causation that innovation doesn't exist because of the labor market, but you never discuss, of course, and it would be very difficult to discuss what is the weight of the importance of such mechanism to explain the lack of innovation in Europe. And then my question is, do you think, after considering everything, that the labor market institutions are more responsible for the fact that we missed the ICT revolution and all the rest of it because of the labor market or because of the absence of capital markets?
Very, very good. Thank you very much. Well, you know, we have some rigidity with respect to the time limits, but...
I'll be fast. Richard, the sluggish productivity growth in the UK, I think, is one of the biggest puzzles. And some of the graphs that I mentioned omit also the UK. Often I call it also the euro area when I mention Europe sometimes. I think John van Rienen is working on that now in the UK. I'm looking forward to seeing the explanations he comes up with and the policy implications. But I think the UK is doing better on some of the high-skilled professional services, finance and also tech, than Europe, but it doesn't seem to show up, and that's one of the big puzzles in Europe. Ricardo's comments on the unicorns. The unicorns are rare. It's a small sample size, but I think that's a same thing for the comment over here. You can look at this, and then you can tell a story. That's your alternative story, and indeed the predominant story that I contrast the labor market institution story with. That's the big question. Is it capital markets, or is it, I mean, that's an alternative offering in the paper, is it labor market institutions, which I think comparatively have been understudied. And if I were to press you, what's the causal microeconomic evidence on capital markets leading to innovation in ICT adoption and diffusion of ICT? I think we also largely rely on correlations or the discussions over here.
Thank you very much, Benjamin.
Yeah, let me just add very quickly that obviously it's a multi-causal issue, the low productivity growth. It's not either or. And I just want to stress also that we have been talking about the European capital market for more than a decade, I would say. So we are aware of that, and I think we should keep pushing for it. But the labor markets, I mean, we have been very silent on, and I think I would see it rather as complementary. And yeah, that's the role here too.
Very good point. You know, a couple of questions there and there. You know, I'm pleased to the point and concise. And Andy Bailey, finally.
Adriana Kugler, Board of Governors of the Federal Reserve. So thank you for a very interesting presentation and comments. I completely agree with what you just said, Nicola, that it's not either or. It's not labor market regulation or product market and capital market regulation. They're complementary. And there's some really good work on this back in the 90s, early 2000s, showing microdata and evidence from microdata, looking at the complementarities between product market regulation and labor market regulation. To the most recent period, I would point to the business formation and how business formation really there was a huge disparity in terms of business formation in the US and in Europe. And that contributed, that can show how business formation really contributed about 3 million jobs in the US. It contributed to sector reallocation as well. So it's not just job to job from firm to firm, it's across sectors at a time when there was rotation from goods to services and back, right? So I think that's an important point to look at recently and how that has increased productivity. The second point is I think preferences and culture is one explanation you can give to this. The other explanation is that if you look at data from the US moving away from employment at will, you see increases in productivity during that time in the US back in the 1990s. And that can be attributed to specific skills, right? Investments in specific skills, in firms, in sectors, that reduces mobility. And so there are kind of two explanations to this. You can go to culture or preferences, if you will, or you can say, well, this is actually due to investments, right? These institutions lead to different investments. And I think that's an alternative
explanation. Please go to the point, because we are exceeding our time. And, you know, we have two more questions, please.
Berkeley and Goethe University Frankfurt. Two brief points or questions. One, you mentioned this, that people don't switch jobs or go to other companies. If I look at Germany or other countries in Europe, one feature is that the large companies have been the same as 10 years ago and as 20 years ago. So there seems to be, say, Siemens, if you have a job there, or BMW, it seems a good idea to keep it and grow there or get promoted there, because there's little change in terms of who are the big companies. So that could be one mechanism, how important it is in terms of the demand side from workers. And then in terms of moving to the US and where the growth with the small to large new companies happens, I'm skeptical about the point made about venture capital. A lot of German venture capital, for example, is moving to the US and going there also to German companies who scale up in the US. And I'm wondering if it's not so much profit opportunities, profit and growth opportunities, and things such as labor market regulation, digital regulation, and other things which just make it more risky to scale up here and more profitable and less, in a risky environment in the US. So that would be a channel maybe which helps your point.
Very good. And finally, Andrew,
Yeah,
please.
it's really, really interesting. Very quickly, and this may help with the UK puzzle. I wonder if we're spending too much time on unemployment now, and that actually the answer is to look at non-participation. In other words, unemployment plus inactivity, those who are not in the labour force, not seeking to be in the labour force, as well as those who are not in the labour force and seeking to be in the labour force, because we certainly appear to have seen some shift from unemployment to inactivity. Yet when we want to look at the questions you're rightly focusing on to do with productivity, we need, I think, the broader look, not least because that's going to be determined also by the long-run demographic trends. Thanks.
Thank you very much, Andrew. Nicola?
Yeah, so very fast, we're out of time. On the last point, I mean, the employment to population ratio has been increasing in most European countries. So I don't think we have this shift from unemployment to non-employment. So there is really a shift into employment, and that is good news. It's just not large enough to overcome the other movement that I was pointing to. So let me stress that and leave it as this.
Benjamin?
I would agree. As we increase the employment population ratio in Europe, which has been happening, and unemployment shrinks, I think it's more and more important to look at how to make the employed move to productive jobs. Governor Adriana Kugler, I think you've done work on employment protection in the United States and employment at will that has shown exactly the mechanism that you were too modest to attribute to your own research. You're one of the few scholars that I think has linked US employment protection regulations across states with the outcomes that I try to shed light on over here. And I think we should do more on that on Europe as well. And Volker, your point about European careers inside large companies being maybe the preferred choice, that's exactly what we see in the data. But perhaps that should be viewed as an equilibrium outcome of all the institutions that Nicola and I try to put our finger on, and maybe another world is possible, but maybe not preferable, and I don't want to overstate anything.
Well, thank you very much. I'm going to be very short. I am not as pretentious as trying to summarize, but perhaps the conclusion is that labor markets matter, and they are very relevant. So thank you very much, and applause for all of you.